It's great to have you, CB.
Thanks for coming in. Yeah, my pleasure.
There was a time where we talk about the 10-year with a solid 5 handle sounded alarmist.
Yeah.
You don't think so anymore?
I don't think so at all. And it's really this paradox. If you look at what has happened since that, what appeared to be a very benign CPI print back in July, yields have gone nothing but straight up. That was 50 basis points a year ago. And I think what's important when you put this in some historical context, the question we're getting from clients is, why would rates still be going up if inflation's falling? And our answer is very simply, when you look historically, rates tend to trade at a premium to CPI. I think the historical average is something like 200 basis points over headline CPI. So we posed the question in our work this morning, is a 3% CPI number and a 5% 10-year yield number that out of bounds? Not at all.
Chances we could overshoot?
I think absolutely. If you just do a pure kind of technical target from the breakout here, you're looking at 490 to 510. I think that's very much in play here. You've seen real 10-year yields decisively break out as well above 2% here. And I think where this is manifesting itself is how the leadership complexion of this market, I think, has changed pretty dramatically over the last 12 weeks.
Interesting. Meaning we were, reliant on FANG and now not as much? Or
Yeah, I mean, if we look since that kind of July CPI print, energy's outperformed tech by 1,500 basis points, discretionary by 1,200 basis points. So you've seen what began as a pretty subtle shift actually become a much more overt move over the last couple of weeks. A little mean reversion today. I wouldn't chase that. I think that's a bounce in a downtrend. I think ultimately the bigger message is that energy has reclaimed the flag of leadership here, and I think rates have a big part about that.
Right. So you're looking for some loss of momentum in technology in particular.
Yeah, and I think we've seen it. I mean, just go stock by stock. All these bellwethers have, in many cases, lost their 50-day moving average, so the short-term trend. Right. More and more are starting to lose the 200 here as well. So I think when you think about this in terms of, where are the most attractive technical setups, what was tech for a good chunk of the year, I think that's deteriorated in a pretty meaningful way. I mean, think about the big names. Apple below the 50-day, Microsoft below the 50-day. It's really NVIDIA, which is the last holdout here. They say the best ones fall last. Expectations are really high for this Wednesday number.
Right. Although for the NASDAQ to go to the 200 would require something truly ugly, yes?
Yeah, it's funny. I think both of these statements can be true. Stocks can be in a longer-term uptrend, and also they can revisit their 200-day moving average in time. We forget that 15, 20% corrections are not abnormal, particularly in an environment where interest rates are more volatile. So I'm kind of thinking about this more in a 1990s, 2000s, or even if you go back further in time, 1960s type environment where volatility in rates leads to more volatility in equity.
Finally, home builders.
Yeah.
You think sledding gets tougher from here?
Yeah, I think you had the first real meaningful crack of what was a very resilient group last week. And it's a reminder that there's no untouchables in this market. And you broke the 50-day on Lennar, you broke it on D.R. Horton. There's a lot of air between where they trade today and the 200-day. I think ultimately lower here. They're oversold. They can probably bounce in the short term. I'm more inclined to fade that.